Joining me now is Kevin Mon, President and Chief Investment Officer at Heinion and Walsh. Welcome.
Good morning, Ashley.
Good morning. So great to see you. So the Dow and S&P are both coming off a record close. What do you think is driving the momentum?
Yeah, what a year it's been, Ashley. Who would have thought back on April the 8th when the S&P 500 was down nearly 15% that we would be at where we are today? As I understand it, we've had 41 record closes thus far this year on top of 57 record closes last year. We have the S&P 500 trading at elevated valuations, both on a current and a forward-looking basis. But I still see room and opportunities for growth here. And I think each time you see a short-term bout of volatility between now and the end of the year, you're going to see money coming off the sidelines and chasing the returns that many institutional and retail investors haven't enjoyed thus far this year. And that money is likely going to the same areas of the market that have led the markets as high as they are. That's technology, that's the infrastructure play, that's utilities, that's aerospace and defense, and now it's also become healthcare and biotech. So it's very encouraging to see this rally expand just beyond the Mag 7 and information technology and AI, because that gives more sustainability to this bull market run.
All right, and Kevin, the Fed cut interest rates for a third straight meeting on Wednesday. What are you taking away from what the Fed and Jerome Powell said?
Sure. So as widely expected, they cut by another 25 basis points this week, the third such cut of 25 basis points this year. And that brings the Fed funds target rate to a range of 3.5% to 3.75%. Why is that important? Well, the Fed has told us that their neutral rate is 3%. So that would suggest that we should only expect two more rate cuts of 25 basis points. Now, do both of those rate cuts come in 2026? Does one come in 2026 and one in 2027? As their dot plot chart suggested, time will tell. But we also have to remember that Chair Powell's term is coming to an end in May of next year. And in all likelihood, the new Fed chair, who will be appointed by President Trump, will be more dovish leaning. So that could create the opportunity for even more rate cuts than we're currently expecting. Any such rate cut is a tailwind for the markets at this point in time, unless they're cutting rates because the economy is dramatically slowing or unemployment is dramatically rising. According to the Fed's own forecast, those two things shouldn't happen, though.
All right, and how are investors approaching the Fed as we enter 2026?
I think you have to look at the Fed right now and expect maybe some modest rate declines, but don't expect much from them. But we also heard some interesting updates in terms of their forecasts from their summary of economic projections on Wednesday. In particular, they increased their outlook for real GDP growth to end this year at 1.7% and next year at 2.3%. Modest but comfortable growth. They kept their forecast for unemployment exactly where it was back in September, to end this year at 4.5% and then come down slightly to 4.4% next year. And most importantly, they did lower their forecast for inflation to end this year at roughly 3%. Remember, core PCE is their preferred inflation gauge before coming down to 2.5% next year. So if those forecasts hold, that's a positive, because that means the economy is continuing to grow, albeit modestly, and inflation continues to come down, albeit modestly. So perhaps we'll get one more rate cut next year, but the market shouldn't be banking on too many additional rate cuts in 2026.
All right, and here at the New York Stock Exchange, Time rang yesterday's opening bell after it named the architects of AI as the person of the year. How are you approaching AI, Kevin, as we enter the new year?
Yeah, I certainly think AI was the theme of the year. I'm not sure if the people behind AI were the people of the year. I think there's many worthy candidates that could be discussed in terms of people of the year. But AI was certainly the theme of the year. And I still contend, Ashley, I know I said this when I was on with you last time, but if I could just use that same baseball analogy again, in terms of the AI revolution and what inning we're in, I still believe we're just in batting practice, and there's a double header ahead. Now, this AI revolution is going to be a very long road with many twists and turns and many potholes along the way. But where the money is being spent right now and continues to be spent is on the AI infrastructure play. building out these data centers, whether it's AECOM as an example of the companies that build these data centers. How about the necessary cooling solutions from companies like Vertiv or Modine Manufacturing or even Comfort Systems, and the electrical capacity, and of course the power, which brings in natural gas and nuclear capabilities. Those come from utilities right now. So that's where I truly see the opportunities. You need to be patient if you're investing in the AI revolution, but look to follow where the money is being spent. And for at least the next 3 years, it's being spent on AI infrastructure.
All right, and we have about 30 seconds left with you, but looking ahead to next week, we have the November jobs report on Tuesday, followed by fresh CPI data on Thursday. What are you anticipating?
I think we're going to continue to see concerns with respect to the labor market. Obviously, the Fed is concerned as they become more attentive to the labor side of their dual mandate than they have to the inflation side. I don't think we're going to see any significant spikes in inflation data. So we'll continue to see modest declines in inflation over the balance of the next year, year and a half, while unemployment will remain a concern. So I'm going to pay very close attention to that jobs data.
All right, thank you, Kevin Mon, President and Chief Investment Officer at Heinion & Walsh.